Very good evening. Very good evening. This is Mahesh Kathiravan, financial freedom specialist. And today I will be talking about what are debt investments. Well, there are a lot of issues going on about the debt, and really it has been a very burning topic because you must have seen 1 or 2 months back. Recent There was a recent case of Franklin template debt funds going busted. So rest assured, there is no problem such as it's just something happens in between is the management or the selection of the companies or the stocks. But rest assured, there is no problem with the overall debt structure. But today we will be quite talking about debt investments tools. The various debt investment tools, which as a financial investor you should know about, and what exactly the operation is, how it is operating, and what is the background of that particular tool, so that you can get a knowledge about it. Because my intention is to just help you to share the knowledge about all the various types of investment, personal investment tools, various investment tools, so that you can get an idea about what exactly is personal finance. Yeah. So without starting with, I will just give you a small introduction of myself. I am Mahesh Kathiravan, financial freedom specialist, father of two lovely goldfish, husband to a super duper marathon runner, sales executive turned banker, then a life insurance consultant, and now founder of MBK Financials as financial freedom specialist. My mission is to help 1 lakh people to achieve financially happy life. So let's start. So before starting, I just want to make you understand what exactly is debt. So debt is a sum of money that is owed or due. Now this is a Google transaction, and it's a simple in English. If I to say, a debt is a sum of money that is owed or due. Now the main features of debt securities are an issue date, which is very important, on which the debt security is issued, an issue price at which the investors buy the debt securities when it is first issued, and a redemption or a maturity date on which the final scheduled repayment of the principal is due. This is the many three features of debt securities which you need to understand, because if you're not able to understand these particular things, you will be not able to go ahead. Okay. Today I will be talking about debt investment tools, which is very important in terms of personal investment and overall structure of financial body. The very first thing is call money. The second is certificate of deposit, which is properly known as CDs. Third is zero coupon bonds, and fourth is commercial paper, or popularly known as SIP. Right? So So today, because this will be a very deep inverted of topics which you need to understand, and that is why I will be doing it in very simple language, simple English language, so that a common man also, layman also can understand what exactly it is. Right. So let's start. What is known as call money? So before that, I will be sharing you a little analogy or a story about you, so that you can correlate with what I am saying. Okay. Say for example, you are on a holiday. Okay. And say for example, holiday means 1 or 2 days, like in this COVID kind of thing, and kind of situation where you're getting 2 or 3 holidays from your office, and you're just lazing off with you and with your family, and you're just lazing on a couch or just on a bed and watching some movie by Amazon or Netflix. Okay. Suddenly, it is in the night. Okay. And suddenly, someone rings the doorbell. You open the door, and suddenly it's long distance relative. Notice I'm talking about pre-corona era. Okay, you have to go back to that era, and who have suddenly made a visit at night 11:30. You are really surprised, but you can't show your displeasure, right? But you still welcome them, and will be offering you coffee and tea, right? However, your wife or your husband will whisper to say that suddenly there is no milk at home. It happens, right? When I was a child, when we used to have some relatives or some brother-in-law or brothers come, father's brother. So we used to have some this kind of situation. So what we do, we just go to our neighbor, and because all the neighborhood shops will be closed around 10:30, 11. Is I'm talking about 80s and 90s, around 85, 90, 1990s. So that time the shops were not close, not open till 12 or 1. Okay. So 10:30 maximum 10 to 10 it will be closed. So what will happen? So you're not left with any options, and you will be knocking out your neighbor's door, okay, to borrow some milk for your gut or some sugar or something sweet. Really, to return, you will promise that you will return at the next day as the shop opens, or you will get another pack of milk. Okay, but now what has happened in this situation? Your friendly neighbor becomes savior, your helper, and saves you from the embarrassment. Because right now, when relatives come and when you don't serve them, it is like a kind of insult of them. Right? So likewise, in the money market, a call money serves as a savior to the banks facing temporary cash crunches and lends them overnight money to ward off this shortage situation. So likewise, when you are maybe facing the problem of milk shortage, say for example, same way, the banks also face the shortage of money crunches, something or other, and it faces. We never know because this is what happened in the banks level. We as a common investor, we never know. That's what today I am going to uh, decode this thing so that you will come to know what exactly is happening at the back end. Okay, so this is very important. That is what this analogy I shared with you so that you can correlate with what is exactly the call. Now, what is exactly the call? This is very important thing which you understand now. So the call money relates to day-to-day fund requirements of bank. When one bank faces a temporary cash crunch, it borrows from another bank and that has surplus cash for a period of 1 to 15 days. Now, typically, bank borrows to bridge the temporary shortfall, but that's not the thing. The borrowing and lending is always on an unsecured basis. Now, what do you mean by unsecured? It's like your personal loan, where you're not giving anything for a collateral. This is what happened in the personal loan. Okay. So so simple English when you say when a bank faces a temporary cash crunches, it borrows from the another bank that has a surplus cash and for a period of 1 to 15 days, and typically just to uh, safeguard the shortfall of to balance the shortfall of the one, and this is always on the unsecured basis. Okay. Sorry. Now, when money is lent for 1 day or overnight, what is called? It's called as the call money. Now, if it exists 1 day, it is referred as notice. And term money will be referring to the borrowing lending for a period of existing 14 days. This is the three types. Okay, call money, notice money, term. What is call money? It left for only lending for 1 day or overnight basis. Like for night, they are taken there, and at the morning, just like 12 a.m. So around in the morning 7 or 6 a.m. or 6 a.m. they will be funding that money to the particular bank who is lending. Now, some chance, some maybe some time the money will not come from the RBI. RBI must have not got the money or from the main office of the bank. They will not reach to the branch. So sometimes it will exist on 1 day. So then it will come into a notice. And when the period exceeds 14 days, it will come into a term. Okay. Now, who all can participate? It's not a common man who will participate. In this market, it's only the banks and primary dealers are only allowed to borrow and lend. So this is very important segment, my dear friends, in the Indian money market. You need to understand because this in this market only the banks and the primary dealers are. So this is not a retail investor are not investing that or no, they are not allowed in that. Okay, so that is why the retail investors are not knowing what is exactly call money. So today I am showing to that only what exactly is call money, what are the exactly that. Now the question will be basically, yeah, we are going to the bank to take money and bank is themselves borrowing the money. So how does this equation work? This question will come to your mind, right? This question was also came to my mind when I first got into call money because I was working in a treasury department of a corporate bank, and when I came to know about this, I had the same question also. So what exactly is this? See, banks have to maintain a mandatory minimum cash balance known as cash reserve ratio (CRR). Now, if you hear RBI's monetary policy very clearly and very carefully, you will hear this term always CRR or SLR, another thing, statutory liquidity ratio and cash reserve ratio. Now, the cash reserve ratio is that the banks have to maintain sufficient liquidity for their day-to-day operations. Say, for example, if you take your neighborhood branch, okay, any bank, and they have a 15 lakhs to manage their day-to-day operations. So people come in and withdrawing the funds from the ATM also. So they have some cash limit for the ATM also. This all together, say for example, 10 to 15 lakhs of that. Now it depends upon the city to city, location to location, and what area is covered. Okay, some branch maybe having 1 or 2 CRs or maybe 20 CRs. That depends on how the branches work. For some time, what happened due to some reason like festivals, will be there, like festivals, a long bank holidays. You remember 2 to 3 days, Friday, Saturday, Sunday, Monday. So 4 days are there. So it puts a lot of pressure on the ATM system as well as the bank people. Or they need to recover that and they need to understand that 4 days are coming. So from Thursday, they need to keep a cash reserve ratio very high above their basic requirement. If they don't do, then they have to lend borrow the money of the other. Okay. So any surplus or shortfall could be made to the call money rule. So that is okay. They can lend that money, but it is that they have to pay the interest. That is all. Like we always lend money. Now, simply when I put in the simple language what I want to say about call money, the call money is a purpose of meeting the short-term liquidity requirements of bank. Now, another example, if I want to share of your daily life, say for example, you want around 100 rupees or 110 rupees. Okay? Say for some requirement, you had stepped out of the house having purse only about 50 to 60 rupees. Just imagine like that kind of situation. And suddenly, out of an important requirement wherein you have put some money to traveling or bus or rickshaw or anything, and suddenly what has happened, the amount got high, and you don't have that money, 60 rupees only, there are 40 rupees deficiency. So what you will do, you will ask your friend, or you will ask your office guys, anyone will there, right? Or else you will ask the auto rickshaw dealer, can you please wait for one day, I will give the money. So simple language is that only meeting the short-term liquidity requirement. So this will not happen in your daily life. No? The next day you will realize, okay, today I have spent on 100 rupees, in that only 60 rupees I have had my pocket and 40 rupees extra. Tomorrow I will go with 100 rupees. So this is for the short-term liquidity return. Now, now what is the impact on this? Is very important thing. What is the impact on that? See, bank will lend the money, bank will borrow the money. That is okay. But what is the important impact? That is very important. So the interest paid on the call money is called call rate. The call money, call rate. Now, eligible participants are free to decide what interest rate would be. They are dependent upon that. So the lender will be free. It will be given a full hand, free hand to decide what the interest rate. So this is very liquid money market, and is the main indicator of the day-to-day interest rates. So this is very important. If the call money rates falls, this means there's a rise in the liquidity, and vice versa. If the liquidity falls, so your call money rates will be high. And liquidity means so much of money, liquid money is there in the market, and money is rolling. So that is why the call rates will fall. And vice versa, if the liquidity is there are a lot of money crunches. Like you see in the starting 1 or 2 months, there was a lot of money crunch due to Corona because a lot many people are not going home, were stuck in their own places. Some people are not going to office. So a lot of things were going on. At that time, a lot of money crunches were there. But once that lockdown eases down, then suddenly the liquidity starting to grab up the situation. Now, the call money rates also have implications on the monetary policy also. Say, for example, if the bank is always lending, okay, that is also a very important. And if a bank is always borrowing, then it will have a lot of implications on the monetary policy. So, what does RBI do? RBI got a guideline. If the call rates, that is the interest rate, if the consistently trading at a level which is not in line with the RBI policy rates, then RBI what he will do OM. OM is what? Open market operations to infuse or stuck liquidity from the market. Say for example, some RBI policy rate will be saying 6.4 or 6.8. I am just assuming I'm saying, I'm not saying the exact figure, this is just for assumption. And the call rates are not in line of 6.4 or 6.8, it's going way beyond that. So like 7.8, 8.9, 10%. So this is very high. What will RBI do? Then it will conduct the open market operation, OMO, which will do that. RBI will be pumping for more money or will set liquidity so that the call rate will fall down and it will always be. But this is the way they come into check. This is very important. So, so we have come to the end of call money. So there's one disclaimer I want to say. because these views are what I am expressing. I'm telling you this all the information, knowledgeable purpose. You need to understand what is my main aim is that I need to make you understand because what my policy is that learn, implement, and teach. I am following this golden triangle. So what I learn by my own experience, I am implementing it on my own life, and then I'm sharing it. So this is the department I was working with. I've been experiencing a lot. I know what is happening exactly. I have a heart of. They will always say that the treasury is the heart of the bank. So that is very important. So you need to understand that kind of. Okay. So let's move on the second instrument that is called the certificates of deposits or popularly known as CDs. Okay. Now you have heard this time and again. You know, I know you will heard like the deposit, you must have heard certificates of deposit. But actually, if you don't know, I will again tell you what exactly is it. But some of the questions, extra question with my client also ask, what does exactly CD mean? Who issues them? Who subscribes to them? So I will share you with an example what exactly this means. Say for example, say Mahesh, I am wanted to borrow around 20 lakhs for my business venture by next week. Okay, so today is Monday, and by next Monday, that is 17th of August, I wanted some 20 lakhs for this new venture. So I go to a bank and I ask for the loan. So bank agrees to give me a loan because seeing my good credit score and everything or a good relation with them. But it came to realization that when they checked their treasury, their own wallet, they realized that it has only 10 lakhs hand. Okay? So there is a deficiency of 10 lakhs. Now the bank will not use me, right? So they what will they say you come again later to collect the loan amount. Say for example 20 lakhs is there my total amount. So they will give me around 8 to 9 lakhs or maximum 50%, and they will say 50% you will get it take it later. Okay. Now the question will arise how the bank will provide the additional 10 lakhs. So now here the corporate relationship will come into play. That is why the corporate relations is very important in terms of the bank operation or the bank. Okay. So bank has corporate relations for whom they can borrow. What does mean the corporates with a lot of corporates? Okay, small corporates are there who are also lending the monies. So if you see the balance sheet of any company, you will come to know they have also have certificate of deposits. So that means they have a relationship with the bank also. Okay. Now, in order to borrow, what the bank will do, bank will issue the certificate of deposit. So one certificate that is just to this is the document in which they will say that you corporate relations will have to subscribe. What obviously the rate of interest offered by the bank to the corporate institution will be higher than the regular. That is obvious because this is not the regular FDs which are we are getting. The bank is borrowing, not the retail investor is borrowing, right? Like I am not going to the bank. Bank is going to the corporate. Okay, so the company, the money will come to the bank once this process is done, and then they will lend me the 10 lakhs, and rest they will keep it as tip or they will give it to something else. So it became the financial instrument issued by the banks at higher interest rate than FDs to entice corporates to park money with them in order to meet a lending need. Now, what does certificate of deposit is? Like I said, a maturity date is very important, a specified interest rate, and it can be issued in any denomination. So it may be, like I told, it will be very high amount. So it will not be thousands, it will be lakhs, or maybe it will be sorry, it may be in crores. Now, it is generally issued by the commercial banks, so not issued by the NBFCs or PATPs. It's only the rule of RBI is given by only to the commercial banks, so commercial and private banks. Now, the term what is there, it will usually range from 1 month to uh, 1 month to 5 years. So, like I said, again, I will repeat the whole process how the CD works. The borrower approaches the bank when the bank realizes that they don't have that much money what the borrower is demanding. Borrower bank will lend the money, but how it will lend the money? It will go to corporate to ask for the money. Corporates will put the money in the bank, and then the bank will lend the money to the borrower. That's the whole process. The chain is complete. Okay? Now, to finalize this, what is the certificate of deposit? What is a certificate deposit? It's a time deposit or a financial product commonly offered to consumers by the bank. Now, why? Sometimes bank may not have enough funds to provide a loan, so it takes the help of CDs to provide a higher rate of interest to corporates. That is why it is very important. Now, when The term of CD generally ranges from the 1 month to 5 years, like I said. So again, a disclaimer: these views are expressed as a information purpose. So I am following the golden triangle of learn, implement, and teach. So before you take any decisions on this particular product, please, I request get an advice from a professional advisor, financial advisor, or if you want more information from me, if you're a subscribed user, please like the channel also. And if you want more information from me, you can kindly contact me at the email ID and connect at maheshkathiravan.in, and I will be more than happy to help you to more educate. Okay. Now we have come to the end of second debt instrument. The third debt instrument is called a zero compounding bond, a zero coupon bond. Now, what is zero coupon bond? The zero coupon bond is a bond that is issued at a discounted price and redeemed at par at a time of maturity. That means there's a bond which is issued at a discounted price and redeemed at a time of maturity. Now, I will tell you an example so that you can understand what exactly is a zero coupon bond. Okay? So, let us assume that Mr. Mahesh, I can mind me, I am investing, say for example, 920 rupees in a zero coupon. Okay. Now, let us further assume that after 1 year, I will receive 1000 rupees. Okay, for rate of interest will be added. Okay. Now, in the instant case, if I pay 920 rupees discounted price, I will receive 900 rupees per value after 1 year. Okay. Now, the return on yield will be what around approximately 8.7. How it can be arrived? So, 1000 rupees is the interest what I'm getting after the maturity. So, 1000 minus 920 divided by 920. So, it is approximately 8.7. Now, so zero coupon bond is nothing but the terminology used for a bond that is issued at a discounted price and redeemed at a par on maturity. So it will be issued as a very discounted price under the market price that depend upon that, and it will be redeemed at a par with the maturity. So what rate of interest will be, you'll be getting that. Now this all also not for the retailers, it's for the big chunk of investors. Now, the very fourth, the last but not the least, is commercial paper, which is popularly known as a CP. Now, what is that? It is an unsecured short-term debt investment instrument issued by a corporation, typically for meeting the short-term liabilities. What does the definition mean? So, what I mean is that, okay, I will try to simplify the concept because this is very important instrument. See, it is a money market instrument. So, money market is what? Like I said, call money is also money market. Okay, it is issued by the corporates, primary dealers. Like I said, call money will be only where the participants will be the banks and the primary and all India financial institutions to garner money from the market. And the third important thing of CP is to make short-term deals. So now is a very history is there why it was introduced in India and when it was introduced. So I will go to the deep into history of that and let you tell you about this thing. So it was introduced in India in 1990 and it was aimed at providing highly rated corporates with a borrowing option. So while they could borrow from the bank, with the help of CP, they could also borrow from the open market. Now, CP was used to borrow directly from the market, so the rate of interest is lesser compared to the banks. So if the CP is what directly we are getting from the market, like the wholesale market and the retail market, right? If you go to the wholesale market, the price of that same product will be much lesser than the retail product because it's going to via things, right? So to sum it up, the commercial paper is a lower cost alternative to borrowing from the bank. However, not all organizations are in a position to issue CPs. Only the reputed organizations whose papers have a good rating can borrow directly to CPs and save money. Okay. Now again, I will give you an example of real-time example of Future Bazaar. Okay, the Future Group is a one of last retail store of like Big Bazaar. Okay, now they want to raise fund from the market to purchase is merchant. That is the stock. It will go for a bank, right, for a loan. Now they probably it will the rate loan rate will be very high. Say for example, 13% or 15%. But the open market, you could preserve the good loan at only 10%. Why? Because there are a lot many players. Like I said, it's all big players are there who have a lot of money in there. They can give. They are sitting in a position they can give a lot low interest. So from the open market can get percent the loan at about only 10%. So by restoring to instrument like CP, the organization gets a 5% discount. And therefore, by issuing the CP, the organization directly gets it from the investors and bypasses the bank. As a result, it gets to borrow at a lower rate from the market as compared to the banks who have charged more. This process is also called as financial disintermediation, or in other words, getting rid of the mediator, like a middleman. The simple words is that you need to remove the middleman. Like, for example, if you buy a fruit or vegetable from the wholesale market directly, you get at a much lower cost than what you're getting at the retail cost. That's for exactly sure. Say, for example, if you're getting the food for mangoes for 1 kilo for 150 or 200, but if you come to retailer, it will be approximately 350, 400. Why? Because it is passing to via a lot of middlemen. So exactly CP is that way only. If any corporates want to get money, what they will do, they will go to the open market, get that, and who is eligible to issue CP? Like I said, corporates are there. So one corporate will help the other corporate. So if you see the balance sheet again, you will see that. So it's very important. You need to check the balance sheet also. Which companies are issuing CDs, CPs? Which banks are issuing CDs? Also very important. Okay. So corporates are there, primary dealers are there, financial institutions are there, a lot of institutions are there, and there also can give the CP. Now, who all can invest in CPs? So like I said, users can invest in CPs, banking companies, mutual funds, NRIs, and foreign institutions. So they are all having a lot of money. So like a retail investor who are having like 50,000 salary a month, it's not possible. Because a lot of money is going into managing their daily also. Okay. And now, when we talk about the maturity, what is that? It can be issued for a minimum of 15 days to maximum of 1 year from the date of issue. Say, for example, 10th of August, today, if it is issued, so it will be up to the 10th of August 2021. So, it is very used. It is used only to fund the working capital of the current requirements of the organization. Say, for example, if they want some capital from corporates to run the organization now for some urgent need, then only they will fund it. This is not money will be not used for marketing. This is only for the manufacturing or buying the stock or just exporting the stock like that. Okay. Now, some other benefits to of the CP is that see, it does not need to be registered with the SEBI, Securities and Exchange Board of India, as long as it matures before 9 months, that is 270 days. This is very important. Another important note is that borrowed amount can only be used to fulfill the current requirement. Like I said, it is not meant for purchase of fixed assets such as a new plant. If any corporate buys that, it will come into purview of the regulators and it will go into that. Because it's clearly only for the working capital current requirement. So if the corporate is facing the crunch of cash and they want to buy the stock, they will buy the CP. But if they are already looking for a new place or new plant, they will not get it. Okay, so that is very important. Now, again, I have the addition bonus. Like I always say, I give a more value to what the learning what is. So there is another product is the treasury bills or T-bills which are called, which is exactly the same as CPs, except that while CPs are issued by the corporates, while the T-bills, that is T-bills, are popularly known as treasury bills, they are issued by the government for financing its working capital. Okay, so like corporates are having working capital, and government is also having working capital. Okay, that is also important. This is a bonus knowledge which I showed you. Okay, because I have shared only the 4 topics, but this is the extra. To sum it up, what is a commercial paper? CP. CP is an unsecured money market instrument issued by the corporation or a bank in the form of promissory note. Why? It provides the organization a borrowing option other than the bank. When CPs are issued, they are issued only when the organizations need to borrow money for completing its working capital requirement. Now, how? Once a business became established, it can issue CPs, but after having rated fully. So they have a rating agency like CRISIL or Moody's. They will rate the CPs of their particular companies or corporates or financial institutions or investors. You need to find out which paper is proper and which paper is very good, and then only you can go. Okay. So last but not least, a disclaimer which I wanted to say: these views are expressed are only for the information purpose and knowledgeable purpose. If you want to go more deeply into that, please contact your financial advisor, or you can contact me also. so that I can help you in understanding more better about these investment tools, because this has to be more deeply. But this is now for the overall structure. I have given you what exactly is CP, what exactly is CD, what exactly is call money, and what exactly is treasury is. Okay. So thank you so much. Hope you have taken some value. I think I have given more value. And if you feel that this video has added value to your life, then please like, share, and subscribe to my channel. There's a bell icon in that. You will get all the updates on there, and so that you will get every time, because tomorrow also I'll be posting some videos, so you will get all the updates on that also. And more, if you want any doubt, if you had any doubt related to personal finance or any finance related things, you can contact me at connect@maheshkathiravan.in. That is MAHESHKATHIRAVAN.in. You can contact me at any time. I will be replying back to your mail, and we will be getting connected to you. Yeah. So before going, I would request, if you feel this knowledge had added value to your, again I'm telling you, added value to your life, then please share this video to your friends and relatives, so that they can also get benefit, because this kind of information not available. There are a lot of information available in the market. It's not churned out, not perfectly tuned and catered to particular your need. This is what I am doing right for you. So if you feel that it has added value to your life, you must have learned something, one or two things, so you can get it done and post. Okay? So thank you so much. Have a great night, and God bless you. Stay blessed, and come tomorrow also. Tomorrow I will be posting the video. Come to my channel, you will get a video, and you will also learn a lot of things about financial freedom. Yeah. Thank you so much. Stay blessed. Cheers.